Thank you for having me. I'm really excited to be here. Like, I'm really excited this morning, and I needed this excitement because, as Thomas mentioned, these are really tough times. They're literally dark times. If you look out in the middle of the day, it's dark here in California. But, you know, the work that CleanStart is doing, the work that our community is doing really does lift my spirits. And so I appreciate the opportunity to be here and share with you today. So we can go ahead and move on to the next slide. All right, to-dos. Okay, so these are the to-dos that I thought of that I just wanted to share with you. So number one, radical self-care. This is not business as usual, as we all know. And yes, we want to be productive, we want to be positive, but we also need to be mindful that these are stressful times. And, you know, it's important for our immune system, for our families, for our communities, for our mental health to really take care of ourselves. And then, you know, next on that, love your neighbor as yourself. So wear a mask, you know, be thoughtful of what other people are going through during these really stressful times. Even people, your enemies, you know, if we lead from a place of empathy, I believe that we can create more positivity in the world. And the third one, and these are all like seriously my to-dos, meditate and visualize positive outcomes. So those are my to-dos I wanted to share with you today. Next. So as you know, I'm Mariah Lichtenstern. I'm the founding partner of DiverseCity Ventures, where we capitalize on diverse perspectives. Next. And our thesis is centered around investing in companies that have positive social, economic, or environmental impact, inclusive teams, and high potential for outsized returns. This is not new, this is not trendy, this is who we are. Next. So in these times, we really can't afford not to invest in companies that are delivering positive social, economic, and environmental impact. Impact investing has grown 10x over the past decade, and it's projected to reach $3 trillion post-COVID. Social impact in particular is often overlooked, even though studies show that diversity, equity, and inclusion leads to better business outcomes. And most fund managers lack cultural competency to really rapidly course correct for the lack of attention to this area, let alone guide portfolio companies who might not have networks that are optimized for diversity. So we have a long-term commitment to and specialized understanding of these subjects, and DiverseCity Ventures really helps our founders to capitalize on diverse perspectives. So I like to remind people as well that diversity includes you. So next. So some fun facts and bragging rights, and you guys can reference this in the slides, but I am a serial entrepreneur. I started my first business as an undergrad at UC Berkeley. I went to grad school for motion picture producing. I earned multiple FINRA licenses trying to pay for graduate school prior to the 2008 downturn, and that's part of what informs the work I do now. And during the recovery, I operated a media and technology consultancy for a number of years. Locally, I launched the Founder Institute chapter, which has graduated 2 cohorts before, sit on the board of Fourth Wave Female Founder Accelerator, and I serve as a key advisor for Berkeley SkyDeck, Village Capital, FinTech Forward, Represent Us, and Yale University School of Medicine's Digital Innovation and Diversity Initiative. I'm also a member of UCLA Ventures and an Aspen Tech Policy Hub Fellow, where I'm working to close the tech industry funding gap, which is what I'd like to share with you today. So next, that segues into. So in Q1 of this year, I spent 10 weeks in residence as an Aspen Tech Policy Hub Fellow in San Francisco. And there I basically drank policy through a fire hose for a month. And then towards the end of the fellowship residency, we set out to solve a policy problem. And the one that I set out to solve was, how can we close the tech funding gap for underrepresented founders, specifically Black, Latinx, and female. So next. Just for context there, 13% of the population is Black and almost 17% is Latinx. Actually, I think the Black population is edging up 14, but less than 3% of that venture capital, less than 3% of venture-backed founders are from those ethnic groups. Next. A full 82% of venture-backed founding teams are all male, and 6% are all female in comparison. Next. So why is this? Generally, we've heard that Silicon Valley, which is the epicenter of technology startups, is a meritocracy, and that the lack of diversity is a pipeline problem that reflects a lack of talent or interest, but this is just not true. So recently, the Kauffman Fellows researchers came out with an article deconstructing the pipeline myth in the case for more diverse fund managers. And it found that neither education nor the number of underrepresented founders in the pipeline could explain just how underfunded underrepresented founders are. They also found that ethnically diverse founding and leadership teams have higher realized returns on positive exits, as you can see here. And happy to share all these links with you. Next slide. So what's especially frustrating about this is that this persistent lack of funding to underrepresented groups has a negative impact on our entire economy. It impacts all of us. The Center for Global Policy Solutions found that discriminatory financing practices that favor white male founders cost the US no less than 9 million jobs and 300 billion in national collective net income. It also puts white men in an unfortunate position of feeling like the default bad guys and burdened, with the blame for a problem that they may not have no conscious part in perpetuating. Next. So with that said, and as an example, venture capitalists bear the brunt of the media criticism for the demonstrated inequities that exist in tech funding. And it's understandable because the data is clear that even if it is unconscious, bias exists. So for example, in one Harvard study, researchers found that VCs are more inclined to fund pitches when the presenter is male. Participants rated women as less persuasive, logical, and fact-based, even when they made identical pitches to their male counterparts. And this was true of both male and female investors, so sadly, but this can be partially explained by pressure to conform to the status quo, and even more so by cognitive dissonance, which is a mental discomfort one experiences when long-held beliefs, attitudes, and behaviors are challenged by conflicting evidence. And cognitive dissonance tends to seek to resolve that discomfort with a rational or unsupported dismissal of facts that cause the discomfort. Next slide, please. Then there's homophily, which is a phenomenon in which humans tend to network, socialize, co-invest, and partner with people who are similar to them. So for these reasons and a number of others related to social and economic engineering, venture capitalists are overwhelmingly white and male. And unfortunately, a 2016 LinkedIn survey revealed that only 2% consider diversity a priority, even though we do see that it has business benefits. I do hope and believe that that is changing in this climate. Next slide, please. But this is why venture-backed founders are more of a meritocracy, with over a quarter of startup funding concentrated in Silicon Valley, and more than half of VCs having a portfolio construction that is 25 to 50% Ivy League founders. So not only this, venture capitalists don't only network and invest in those that are like them, they tend to exclude those who aren't. So next slide. And this is reflected in an underrepresentation of Black, Latinx, and female investors as well, because they're seldom hired into venture capital firms, and they struggle to establish the track records that are required for them to launch their own firms. Deloitte actually put out some research that shows, that when firms are founded by underrepresented VCs, that they tend to they're overrepresented in their own firms as opposed to being part of other firms, and also the age of the firm determines how many. So the older firms are less likely to have more diverse partners. Okay, next slide. So all of these issues are problematic and they're true, but the funding gap starts much earlier. And by the way, the funding gap is something that, yes, it disproportionately impacts underrepresented founders, but there is a funding gap and there's income inequality that impacts all founders. It just disproportionately impacts those who are underrepresented. So anyway, next slide. 500,000 startups launch each month, believe it or not, in America, and 500 billion goes to funding these startups every year. So where does that funding come from? 60% comes from a founder's own resources. So that's those who have savings, inheritance, home equity, other sources of credit. They start with an advantage. Next slide. 38% of funding comes from the friends and family round, which we'll come back to. And next slide. Less than 2% of startup capital comes from angel or VC funding. And you can see an infographic that summarizes these statistics. I put it in the slides for you. And they're also hosted at. It's generally, so the friends and family round is generally required to raise an institutional round. And actually it's often required even for angel investment. And the point of that is really to get your product made, get some traction, get out into the market. Okay. So next slide. Herein lies the problem. The Securities and Exchange Commission at the SEC regulates how founders raise capital, including who they can raise from, how, and how much they can raise. So the regulations that you see here, they all have one rule in common. Next slide. And that is Rule 501, which is defined under the SEC's Regulation D. And I'm not going to geek out too much on this for you, but it is the accredited investor definition. And so I'll also share the links to this infographic also on the homepage, but it summarizes how the rules differ based on the definition. So what is an accredited investor? Next page. To be considered accredited, investors must meet these established thresholds for income or net worth. 200,000 income, at least for the past 2 years, expected to continue, or 300,000 in household income, and or $1 million in net worth, excluding your personal residence. So based on this definition, both founders and funders or investors face separate and unequal access to startup offerings and investment opportunities. Next slide, please. So less than 15% of Americans meet this criteria. Next. And of that, less than 5% are Black or Latinx. 22% are female. Next. And why is that? It's mostly because of income inequality, the wage gap, and the wealth gap. So for context, the average white household has 7 times the wealth of the average Black household and 5 times the average Latinx household. Next slide. And it's wider if you look at the median wealth. Next. So going back, the mission of the SEC is to protect investors, to maintain fair, orderly, and efficient markets, and to facilitate capital formation. But barring investors based on income and net worth really defies those goals. And even commissioners themselves have made statements in response to some recent changes to the rules on how it's contradictory. And there's a lot of documentation on that. And I've had to go down many rabbit holes to get to the root of it. Next slide. So again, it creates separate and unequal offering and investment guidelines based primarily on income and net worth. And the recent updates I mentioned involve narrow financial licenses and occupations. So like the Series 7, which is for stockbrokers, Series 65, I think 82. And then there's a few other little nuanced changes, but there's no change to the individual definition of accredited investor in terms of income and net worth. Okay, next. So to understand the significance of this accredited investor rule, you really have to look beneath the surface to the history of the SEC and other federal agencies that were actually formed during the Great Depression. It was a time of racial unrest. There were Black Wall Streets across the nation that were being destroyed and dismantled. There were, race riots going on. People were one generation, if that, removed from slavery. So there's a lot of social and economic changes happening, immigration, just a lot of stuff brewing. And so then there's, the stock market crash in 1929 that was kind of led up to by, this Gilded Age and a lack of regulation on the public markets. And so during this time, the Federal Housing Administration and the Homeowners Loan Corporation were formed as part of this package to reconstruct America during the Great Depression. And the FHA and the HOLC explicitly excluded Black Americans from creating wealth in real estate through a process known as redlining. The SEC was more covert, and these are 1933, 1934 acts and agencies that were formed under these acts, by the way. So the SEC was covert, and they used the accredited investor definition as a dog whistle. It was a dog whistle term to veil economic exclusion. So I shared to you in some of the work on the website and elsewhere how you can learn more about the political implications of dog whistle politics and policies, where politicians who weren't even necessarily racist themselves would leverage these dog whistle terms to secure the votes of those who were. So next. So while the income inequality makes it hard, again, for most founders to raise capital because of the wealth gap, it's especially harder for underrepresented founders to bootstrap. Next slide. And the accredited investor definition makes it difficult to raise capital from their own communities, even those who have the financial resources and risk tolerance to invest. So, for example, the average income of the 10 most affluent Black communities in America falls below the accreditation threshold. Now, obviously, if you're familiar with Black Wall Streets, these are communities that were thriving. They invested in themselves. There were many businesses. And oftentimes, the reason why they were attacked was because they had such thriving, insulated communities where the money circulated within. And again, these are communities that are like one generation, maybe two removed from slavery. And so not a lot of educational history, but obviously people had the capacity to become sophisticated. So anyway, that's just a little bit of context there. And then it's also interesting to note that, that the commissioners have pointed out that even people who are extremely sophisticated, who are lawyers who regulate, don't qualify. But there are, some commissioners who actually advocate for raising the threshold and reducing the number of accredited investors based on inflation. So anyway, next slide. So the SEC calls the rule an investor protection, but it only applies to the private markets, which is not what the SEC was really formed to protect against, right? It was really formed due to bad actors, insider trading, and fraud in the public markets. But that said, next slide, all investments entail risk, all of them. And regulations are important. I'm not an anti-regulation person. But as I said, all investments entail risk, and the liquidity of the public market also contributes to its volatility. And so the reason why they say the accreditation is needed in the private market and not the public market is because the public market has more disclosures and is more liquid. I would argue against that because there are disclosures that are required in the private markets, but we won't go into too much detail. You may have questions I'd be happy to answer. So anyway, people buy and sell according to various strategies, advice, even headlines. And not accredited investors lose their life savings on consumer apps. I'm sure you guys have heard, or maybe you've heard of certain apps in which people even have margin, right? And so they can lose more than they even have based on that that kind of more sophisticated method of investing. There's calls, there's puts, there's spreads, there's all these strategies that are a lot more sophisticated, in my opinion, than purchasing early stage stocks in the private market of startups. And let us not forget that the most devastating loss to our economy have been in the public markets. And that is, after all, why the SEC was formed. So this is just an example from the 2008 crash. Okay, next slide. In the private market, most startups fail, honestly, or they deliver a modest return. But the reason why limited partners entrust venture capitalists to deploy tens of billions of dollars each year is because it only takes one major win to make up for a multitude of losses. And here is why. Investors buy startups at a fraction of a cent per share at the earliest rounds. The valuations are really a function of ownership and the capital that's invested. They're not as sophisticated or complicated as the public markets. And again, I'm coming from a perspective of someone who was formerly FINRA licensed. So imagine if instead of being limited to crowdfunded offerings, Americans could invest freely and diversify their risks by investing in venture capital funds or other opportunities. But right now, this is extremely limited under the current rules. So next slide. So I don't know if anybody else has contributed to philanthropy or like building funds at the church, but the question that I ask is, how is it that we have autonomy when it comes to spending, but not to investing? Next slide. Even if we were to give the SEC the benefit of the doubt and assume that the accredited investor definition is truly intended to protect investors, is paternalism the best policy? Restricting Americans from investment opportunities does not protect them from losing money elsewhere. Case in point, Las Vegas, taking a European tour, buying depreciating assets or real estate or bonds or other investments for that matter that are illiquid. And by the way, I neglected to mention that there is a study that came out that showed that, especially in times like this, that the private market offers greater security because the volatility doesn't cause price changes. So there's actually some studies that have come out in that regard. But anyway, restricting Americans from investing, it doesn't mean that they're not going to lose money. It just means that they don't have equal access to some of the most lucrative investment opportunities. Next slide. So not everyone agrees with this, of course, and NASA, or the NASAA, is one of the more influential lobbyists. And this is a comment made by the New Jersey Bureau of Securities, NASA president and chief of the New Jersey Bureau of Securities. And he said that it's implausible that the 16 million American households that are accredited, he said it's implausible that they will have the financial sophistication or capacity to bear the kind of investment losses that courts and prior commissions have considered essential prerequisites to participate in private offerings. I can barely follow it. It's such circular reasoning. But that is one of the main arguments, and particularly around senior investors. So next slide. And they argue that the SEC should focus on promoting the public market, and instead of incentivizing raising capital in the private markets, which is strange because every public company was once private. But anyway, next slide. And they feel like the SEC, in coming out with a new rule, has failed to protect investors, particularly elderly. Now, let's see, time check. Next slide, please. Again, all investment entails risk, but investments also entail opportunity. And we do need investor protections, and they need to be placed in the right place. And so I firmly believe in investor protection. I believe that's through disclosure, and that there's easy ways that the SEC can achieve both. And so that's what I propose in the policy brief, which I've shared here. And this is, again, hosted on the website, techfundingequity.com. And so this is one of the solutions that I propose to close the tech funding gap. Number one, eliminate financial literacy tests for accreditation. So the page 2 of that gives my solution, but go check it out, please. Next slide. So on August 26th, as I mentioned before, the SEC announced a new rule for accredited investors, and it does expand it to include spousal equivalents, professionals who pass some certain financial literacy tests. But I would argue that these are reminiscent of voter literacy tests that kept people of color specifically from participating in the civic process. And in much the same way, this is preventing everyday Americans, and specifically underrepresented founders and investors, from participating in wealth generation. And unfortunately, I don't think it's an unintended consequence. I just think it's very well disguised in some very complex legalese. Anyway, next slide. So the next day after this rule came out, the Small Business Capital Formation Advisory Committee issued the following statement. And so what this does is it basically underscores that it is critical that we address the disparities that exist, particularly for people of color and women, when it comes to accessing the markets. Next slide, please. So to help move this along, they are, in most of the commissioners, maybe one did not make a comment, but most of the commissioners have issued comments on this rule. They have underscored that they are still accepting comments. They are listening. So I'm initiating a petition that will be delivered by email to the SEC along with a public comment, and I invite advocacy partners to join us on this. Next slide. This is the Move On petition, so I invite you to participate, to sign that, and to subscribe to updates on techfundingequity.com about this and other initiatives. Next slide, please. And the second solution is around the Opportunity Pledge, which is for accelerating equity and startup opportunities. And this is engaging the private sector, so private equity limited partners who invest in venture capitalists and VC firms. And the goal is to increase investment to underrepresented founders and fund managers 10x by 2025. Next slide. And this pledge includes a framework to help facilitate greater access to diversified deal flow for venture capitalists so they can capitalize on those diverse perspectives and opportunities and returns that we talked about earlier. And also for emerging managers to establish those attributable track records that will allow them to spin out and start their own firms. And so this is not about a name, blame, shame. It's really about creating a support system, not having to reinvent the wheel, supporting people through what can be very difficult. When we talked about the cognitive dissonance, you know, we're all seeing this Black Lives Matter movement unfold. And like, I live as a Black woman every day, and I talk about these issues. I'm an ethnic and Pan-African studies minor, and it's still uncomfortable. It's still painful. Doing this project and just being reminded of the history of our country is painful, but I'm also hopeful. And so, you know, I understand when you've had a privilege of not having to see or experience these things, it can be painful. And it can elicit all kinds of feelings and experiences that make you want to avoid it, turn the other way. And so this is really designed to support people in a sustained effort. And it is worth the work. I have seen it. I've seen people do the work. And at the end of the day, it's very rewarding. And so, and it just breeds a certain confidence and comfort and just being aware and being able to capitalize on those diverse perspectives. Next slide. So in closing, I invite all of you to get involved as we advocate for change and we build out our coalition. Here are some examples of organizations that we're looking to be involved with. And that also includes you through petitions, through comments, through checking out the infographics and just becoming aware of this. You know, like even if you don't agree, just knowing the arguments, understanding them, and even, you know, sharing your thoughts, your concerns, your ideas and suggestions. I very much value and appreciate that. I'm thick-skinned, don't take offense lightly. And last slide, Thomas. So finally, I'd like to acknowledge the incredible support that went into this project and that continues to go into this project. I'd like to acknowledge Dan Porterfield, who is the CEO of the Aspen Institute, who joined us for dinner in January and underscored how dealing with systemic racism and income inequality are two of the greatest problems facing our world right now. And I also want to thank project mentor Chris Russell, who is a local attorney with Stoll Rives, Cheryl Beninga, the co-founder of Fourth Wave Female Founder Accelerator, who's part of our advocacy team. She's also a seasoned venture capitalist spinning out of Intel Capital. Matthew Friedman of the Mekong Club, who inspired the framework for the Opportunity Pledge. Frank Casey of Casey Moats, Jonathan Greachin and Adeo Resi of the Founder Institute, who are two of our partners, and Cameron Law of the Carlson Center for Innovation and Entrepreneurship at Sac State, and many more, including CleanStart, who support this project. So with that, thank you very much.